Welcome back, everyone. We're going to talk today about the subject of how to legally reduce your taxes using trusts and foundations. These are like two of the most powerful tools potentially. They're also probably some of the least used tools, some of the least understood tools. I've got some previous videos on trusts you can go back and check out, but I'm going to cover off, kind of hopefully explaining for you a little bit about how it is that it works and why this can sometimes be useful in cases where nothing else is, but also why it's not a panacea or some magic bullet that's going to solve all your tax woes. So if you haven't already, please smash the subscribe button, hit the notification bell, check out our other videos. We got lots of them. We try to produce great content for you every single day. And if you're interested at all in these subjects of paying the lowest legal amount of tax possible, where to relocate, setting up corporate structures, optimizing your life, figuring out, getting residencies and citizenships, all these kinds of things, please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com, and you can send us a message through there. Okay, so what is a trust and foundation? Just quickly, I've done some videos on this in the past, but basically a trust separates the concept of ownership and benefit. Okay, so most people are used to the idea that I own it and I benefit from it, right? It's my company, I get the profits. In this particular case, when you have a trust, the ownership actually is under the trustee, and so the beneficiary is not going to own it. The beneficiary is simply going to benefit from it. So all the gains go to the beneficiary, or beneficiaries, but the ownership is held by a trustee for some particular purpose, for some particular period of time, etc. Okay, so it's kind of a relationship between three parties, or the settlor or grantor in the U.S., the trustee, and the beneficiary. Okay, lots of details about that. Trusts are super complicated, so if you want help with them, reach out to us. Okay, so that's the first thing, right? And foundations are similar, slightly more like a quasi company trust hybrid, because of the fact that basically a trust is not actually a legal entity in most cases, although it gets treated that way in places like the US. It's more like a relationship, whereas a foundation is actually a distinct entity. Okay, so what's the idea behind these when we're looking at reducing your taxes? So I have this mental model that I use, which is what I call the 3 pillars of residency. I've done some videos on this in the past, and it's the residency of the entity, the residency of the income, and the residency of the shareholders or owners. Okay, and the residency of the entity is not going to be changed by using a trust or foundation to hold that entity. Okay, residency is going to stay the same. Residency of the income is also not going to change in this particular case, right? So you always have to worry about those two things. The third is the residency of the shareholders, and this doesn't always matter, okay? This is where controlled foreign companies, or CFC rules, comes in to play. And again, I've got some videos on that if you want to go and check out about what that's all about. But it's very important to understand you have to deal with CFC rules in a high percentage of the world's countries. Now, the way that it works is that CFC rules are in some way, shape, or form based on ownership. Okay. The thing is, sometimes those are really tough rules to get around. So the logical way of getting around them is to not own the thing, right? Now the problem, of course, is how do you own the thing while still benefiting from it? And this is, again, like, I don't want to imply to you that this is overly simple. I think that the tendency that people have is to overly simplify these things in general, and they can make like some really dangerous mistakes on that. So this is definitely a topic where if you're going to get into trusts and foundations, etc., reach out to me, because it's not one that's easy to navigate. But basically the idea is, rather than you owning it, a trust or a foundation could own the legal entity. And provided that's done in the right way, there's lots of different complex anti-avoidance rules in a bunch of places, but provided that's done in the right way, potentially that could negate your CFC rules. And what that can allow you to do is it can allow you to defer the income. So I've talked lots about how there's kind of 3 ways to save on tax. The one that people are most used to in their home country is reduce your taxable income by increasing your deductions. The second, the one that people seem to kind of pursue wholeheartedly, is reducing your tax rate. The third, which is most commonly seen in things like retirement accounts, etc., is deferral. But in offshore structures, we can potentially get massive deferral for an indefinite period of time. So essentially an unlimited size, retirement account that you can grow potentially indefinitely without paying tax along the way, and that can have a really, really big effect that people grossly underestimate. Okay, so basically that's the idea, right? The idea of using a trust or foundation. It's not that a trust or foundation is magically not going to pay tax or not going to make you pay tax. You're still going to have to follow typically the corporate residency rules. You're still going to have to follow typically the source income rules, the permanent establishment rules, etc. But if structured properly, this can become a way of facilitating long-term deferral of the taxes that are of the income that's accumulated inside that structure, and that can have a big benefit for you. Now, why would you want to do that? There's a few different reasons. Number one is the effects of the deferral in itself are massive. So I've kind of given the numbers before about if you were to grow $1 into $1 million over a series of doubling periods without paying. Basically, it's 1 becomes 2. Basically, if you double $1 every period for 20 periods, I would say 20 years, you end up with $1,048,000 approximately. And so great, that's wonderful. Whereas by contrast, if you were to go and you were to take $1 and you were to tax it each time along the way, so at 33%, 1 becomes 2 less 33% on the 1, which becomes 1.67, and then you double it and you tax the 1.67. The difference is between 1.048 million, this becomes 28,000. So it's such a vast difference that that deferral can be worth a huge, huge amount. Additionally, it's great for if maybe you're sitting in a situation where you're like, hey, look, right now I'm not ready to relocate. Maybe my kids are in school, something's going on, but later on in my life, I'd like to move out of my country. And this can potentially avoid exit tax. It can potentially put you in a situation where you can basically accumulate the money and then realize the gains later. Things like this. Again, not necessarily very precise rules country by country, but it's a great tool if you can do it, if you can set it up well, manage it well, and follow all those rules. So anyway, I hope that helps. It gives you a little bit of an idea on how these things work and how it might benefit you. And if you have questions about it, put them in the comments below or reach out to me. Again, you can book a call, calendly.com/Michael-Rosmer, or check out our websites, offshorecitizen.net, offshorecapitalist.com. And I'm going to look forward to seeing you guys on the next video.